to rent rather than buy? Do you want to wait to buy only when mortgage rates are lower or prices have fallen 10, 15%? So if I had to give an advice to anybody, I would say rent today, wait until mortgage rates are lower and or prices of home are lower. Is not a good time to buy.
Hello everyone. Today, I'll discuss a hot topic dividing opinion in the real estate market. Shelter is one of man's basic needs, but should you rent or buy a house? Nouriel Roubini, a guest on the PBD Podcast, advised viewers to rent now and buy later. Nouriel is an American-Turkish economist, consultant, and emeritus professor at the Stern School of Business at New York University.
What do you like? Let's just say I'm your son, okay? And I'm your family. I know you don't have any kids, but let's just say, I'm related to you. You truly care about me making the right decision. I come to you and I say, Uncle, I got a question for you. I respect you a lot. I'm thinking about buying a house right now. Should I buy right now? Should I wait right now?
Today, instead, first of all, those measures of a bubble in the housing market are showing frothiness, but not a massive bubble like 06, 08. Two, the economy is still growing. So the household might have a balance sheet problem. The interest rates are starting to pay on the mortgages is higher. But if you have a job and income, you can still afford it. Mm-hmm. Mm-hmm. Three, when interest rates were very, very low, and, as of 2 years ago, you could get, as a prime borrower, you could get a 10-year mortgage for 2.5% to 3%. Today is 7, 8. Many people locked in mortgages at long maturity, 10, 20, 30 years, at interest rates that are much lower. So the average person is not paying 7, 8%. The average is paying something like between 3 and 4. Some people less, some people more. And people have jobs. So are we going to have a downturn in real estate? Yes. Is it going to be more severe in commercial, meaning offices and stores and so on? Yes. Could there be risk also for housing? Yes. But if we avoid a real recession, people have jobs and income, and they have now locked in, interest rates are lower. As some of those mortgages refinance, then people are going to find much more expensive to pay their mortgages. And today, I would say, given the ratio between prices and rents, it's much more, much more reasonable for an individual to rent rather than buy. You want to wait to buy only when mortgage rates are lower or prices have fallen 10, 15%. So if I had to give an advice to anybody, I would say rent today, wait until mortgage rates are lower and or prices of home are lower. Is not a good time to buy.
So that Nouriel predicted the 2007 to 2008 subprime mortgage crisis in the U.S. and the following global financial crisis. So you can't take his words with a pinch of salt. Though Nouriel's advice may sound crazy, because why would you rather rent a house when you could own it? Well, sit tight as I explore Nouriel's advice through the prism of facts so that you can make an informed decision. I'll be analyzing the 4 main reasons why Nouriel Roubini believes it is better to rent now than to buy. First and foremost, he believes that houses are currently overvalued. Secondly, he believes that interest rates in the U.S. are very high. Thirdly, he believes that housing inventory is currently very low. His fourth reason is that it's cheaper to rent now than to buy. Owning a house right now, you are likely to spend more on miscellaneous fees and maintenance. Join me as I delve deeper into all the concerns Nouriel Roubini has brought to our attention. Point number 1, Roubini believes that houses currently are overvalued. Well, data shows that a large percentage of houses in the U.S. are overvalued. A recent report by researchers from the Florida Atlantic University and Florida State University validates this claim. The report is open source. You can access it on business.fa.edu. Anyways, this report analyzed 100 top U.S. housing markets. And guess what they found? Homes in 98% of these markets are overvalued. Pretty crazy, right? So if you're buying a home in these markets, 98 times out of 100, you're paying an amount way above its value for a house. Well, the reason isn't far-fetched. There's a housing shortage in the U.S. at this time. Realtor.com estimates this shortage to be between 2.3 million and 6.5 million housing units. I'll explain the reason for this shortage later in this video, but remember the law of demand and supply. When there's high demand and shortage of supply, prices go up. Therefore, it would make sense to rent now instead of buying a house. Buying something, not just a house, is to have value for money. Essentially, it means to get what you're paying for. Secondly, Roubini said that the interest rate right now is very high, which makes the mortgage rates very high in the US. A recent New York Times article by Gregory Schmidt claims that the current mortgage rates are the highest in 22 years. What's the average mortgage rate in the US? According to Gregory Schmidt, mortgage rates are about an average of 7.23% on a 30-year fixed mortgage. Several factors influence mortgage rates, and to help you understand this topic better, let me take a moment to explain how mortgage rates work. Since they usually announce it, you might be tempted to think that banks and lenders are responsible for fixing mortgage rates. That would be wrong. The biggest determinants of the mortgage rates are the MBS market and the Federal Reserve.
But right now we have the MBS market. Why do we follow this? This is basically what I follow, okay? It's telling me what's going on with the price of the mortgage bond, okay? It's a bond that sells on Wall Street. The yield on this thing is the biggest piece of your mortgage rate. So what we follow here is this is what's going on with the price of the bond, okay? So as this price goes down, mortgage rates go up. It has an inverse. Let's think of it as a flip-flop. If this is down, rates are up. If this is up, rates are down. You can see the chart down below. We've been in the red.
Dan Frio talks about the MBS market influence mortgage rates. What is the MBS market? How does it impact mortgage rates? And how do they connect with the Federal Reserve? Let me break it down for you. MBS is an acronym for mortgage-backed security. It's a type of investment that purchases mortgages, combines them into pools, and then offers the investor the pools of loans as a single investment. Imagine you want to buy a house, but don't have all the money to pay for it. So you head to the bank for a loan. Remember that you're not the only person getting a loan from the bank to purchase a house. Millions of other people also collect bank loans for the same purpose. Instead of waiting for you to pay your loan, the bank combines your loan and those of others into a single pool where other people can invest and make a profit. This single pool created from all these loans is called mortgage-backed security. The MBS market is where investors buy securities backed by mortgage rates. So how does the MBS market affect mortgage rates? The rise or fall of MBS directly affects mortgage rates. The price of MBS is inversely proportional to mortgage rates. When MBS prices rise, mortgage rates fall, and vice versa. Why is this so? A rise in MBS prices indicates that investors are willing to pay more for mortgages, hence the rate drop. So how does this all connect to the Federal Reserve? The major functions of the Fed are to manage the money supply, set interest rates, and regulate the financial markets. So about mortgage rates, note that the Fed doesn't directly set mortgage rates, but it can influence them.
The Fed manipulates this rate in order to speed up or slow down the growth of inflation. The Fed also maintains or changes its stance on buying or selling mortgage-backed securities, which also has a major effect on the movement of mortgage interest rates.
Joe Manausa explains how the Fed influences mortgage rates by adjusting the federal funds rate. The federal funds rate is the rate at which banks grant short-term loans to each other. The Fed sets this rate to control the money supply. So how does the funds rate affect mortgage rates? Raising the funds rates has a directly proportional effect on the mortgage rates. How? Banks will pay more for loans when the Fed increases the funds rate. To maintain profit, the banks will transfer these borrowing costs to consumers through higher interest rates on several loans, including mortgage rates. Here's the catch. Mortgage rates will not likely remain this high for much longer. They could start dropping from late next year, although experts differ on the rate.
That's Mark Zandi. He's chief economist at Moody's. Now I'm getting confused, Mark. When do you think that's going to happen?
Yeah, no, did I say, was that a typo, 2025? No, I think 2024. By year end, this time next year, I expect fixed mortgage rates to be around 6%.
Mark Zandi, chief economist at Moody Analytics, a financial services company, predicted that mortgage rates would drop to 6% between the last quarter of 2024 and early 2025. However, the Mortgage Bankers Association is more optimistic. They'd recently forecasted that mortgage rates would dip to about 5% by the fourth quarter of 2024. And other experts like Lawrence Yun, chief economist of the National Association of Realtors, also hold the same view. So renting would benefit you more than buying a house right now. Before buying a house, it would make sense to wait until the last quarter of next year when mortgage rates will reduce. Thirdly, Roubini believes that many want to buy a house rather than sell it, which makes housing inventory low right now. Even if you could afford it, it's hard to find a house to buy right now. The housing market has yet to recover from several dips, most notably the crash of the Great Recession and the COVID-19 pandemic. Let me briefly explain how these events impact housing inventory. First, the Great Recession. The housing market collapse was a domino effect of several events leading to the Great Recession. Housing prices were rising years before the recession in a housing bubble. People were buying homes, assuming their prices would continue increasing, and banks gave high-risk loans to people with poor credit. Banks packaged these loans into mortgage-backed securities, believing they would reduce the risk. The banks also sold these MBS to other countries, spreading the risk globally. Unfortunately, many people couldn't meet up with their loan obligation mortgages, so MBS lost value. This resulted in huge losses for many financial institutions, some even going bankrupt. Consequently, banks stopped lending money, leading to a credit freeze. Businesses and people found it extremely difficult to obtain loans. Many people lost their homes from foreclosure since they couldn't pay their mortgages, leading to a crash in the housing market. There was also the COVID-19 pandemic of 2020. Due to the pandemic, many houses under construction had to be put on hold because materials were either expensive to buy or unavailable. Apart from that, the general population increased because people had to stay indoors for a little over a year. So while the demand for houses increased, the supply was scarce. Another factor responsible for the current house shortage is the summer rush. Late spring and summer seasons are rush seasons in the housing market. During this time, most people decide to buy or sell their houses. Here's the catch. While many people are in the market looking for houses to buy, the irony is that not many people are selling simultaneously, so you have more buyers than sellers. The law of supply and demand kicks in again. Then, the influx of institutional real estate investors into the market also worsened this situation. Using deed record data, the National Association of Realtors stated that institutional real estate investors moved their purchase of houses from 11.8% in 2020 to 13.2% in 2021. There's also the matter of regulatory barriers. Different parts of the U.S. have regulatory barriers like zoning and land use, building codes, impact fees, etc. These regulatory barriers discourage investments in real estate. It's either the cost of the permitted materials for a house being overpriced or the allowed land allocation for a building being too small. Finally, homeowners are unwilling to sell or move. The reason is simple. They won't get their money back. If you sold your house, the expectation would be to move to a better one. Many homeowners purchased homes when the mortgage rate was about 4% or 5%. Mortgage rates are higher now, so selling their homes may seem like some profit. However, buying a new house would take up all the money, if not more, and put them at a loss. These factors contribute to lower housing inventory. Although Realtor.com recently reported a small rise of 0.2% in housing inventory, this isn't enough to meet the market demand. It would take longer to improve the housing inventory, and experts say they don't see this happening soon. Fourthly, Roubini believes that owning a house right now will make you spend more on miscellaneous fees and maintenance. Thus, renting exempts you from the high costs of owning a home. Buying a house comes with extra costs. Apart from a huge initial investment, you'll have to handle homeowners association dues, insurance, property tax, utilities, etc. You're also solely responsible for any repairs, especially if you bought an old home. You'll still have to deal with the repair and maintenance costs over the years. And don't forget you have a back debt, a monthly mortgage, that may trail you for 17 or more years. When you rent, you spend less and save more. You don't have to worry about repairs or maintenance and other costs associated with owning a home. You only need to pay your rent for each month. You'll also have access to amenities that would otherwise be expensive. In many mid-scale to upmarket apartment complexes, tenants are not charged extra for amenities like an in-ground pool or a fitness facility. Installing and maintaining these amenities would cost thousands of dollars for a homeowner who wishes to use them. The costs of these items are included in their monthly homeowners association dues. In addition, tenants are presented with a more favorable financial arrangement regarding the initial payment. In most cases, tenants must provide a security deposit equivalent to 1 month's rent. They would receive their deposit when they move out, provided there's no damage to the rental property. However, buying a house with a mortgage requires an initial down payment of at least 20%, significantly higher than a month's rent. Finally, renting gives you more flexibility as you can move anywhere whenever you want. Add that to the piece of being debt-free. Thank you for watching. Are you considering buying a house soon? Or did you buy a house recently? What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Soon channel. I'll see you in the next video.